By the end of the video, you are going to be in a position to generate figures such as these, and these through trading. So this video is going to take you from a beginner trader to an advanced trader. I'm going to break down all the keywords in trading, and then I'll also share a trading strategy and then some live trading in here. So without any further ado, let's dive straight into it. So trading is the exchange of currencies. We entirely make money by selling and buying a given currency. Now, it's also easy that we profit anytime there is a change in price, whether the price is going up or down. In any way, we are making money. And now these two changes can easily be determined by two types of analysis. One is called fundamental analysis, and then the other is called technical analysis. So under fundamental analysis, we are using the economic data. We need to see what exactly is happening in a given country. So say we are trading the dollar, right? The USD. We might need to know what's happening in the US. Are people getting employed, or could there be anything that influences the value of the dollar? So that's what we call fundamental analysis. And then on the other side, technical analysis is the use of the previous price data to determine what's going to happen in the next future. So we are just looking at what happened yesterday or the previous week or the previous month, so we are able to know what's going to happen tomorrow. Now, the most amazing thing about trading is what happens today is more often going to happen tomorrow. So all you have to do is you're going to come to your charts, establish or draw any levels to see where the price could have bounced off, just like what I'm going to show you, and then you have it done. Now, here are some of the most commonly used terms in trading. Now, the first one is a currency pair. Now, a currency pair is a combination of two currencies. We can also call it a quote. So an example can be, say, GBP/USD or EUR/USD. So basically, a currency pair is just going to be a combination of two currencies. Now you can formulate as many as possible. And now these currency pairs are also divided into three types. And now we have the first one being the major currency pairs. So these are pairs that include the dollar in them. So an example can be, say, EUR/USD, GBP/USD, or USD/JPY. And by the way, these are the most traded currencies. And I would recommend that as a beginner trader, you start off with this. Add EUR/USD, GBP/USD, and USD/JPY on your watch list, so you can only trade those. And now the other one is the minor currency pairs. So these are pairs that are not associated with the dollar. An example can be, say, EUR/GBP or GBP/JPY or EUR/JPY. And then lastly, exotic pairs, and these are just from emerging markets. So that's what you have to know about currency pairs. Now the next one is leverage. You're going to find this more often. So once you open up a trading account, the broker is going to ask you to use a leverage. And by the way, I did a detailed video on how to open up a trading account somewhere up, and I'm also going to put a link just down where you can open up a trading account and you get 200 deposit bonus on any deposit that you make. So entirely, once you open up a trading account, the broker says, well, you can use a leverage. Now, a leverage is just the use of borrowed capital to increase one's buying power. Now, most traders start with less capital, say $100 or say $50. Now, with $50 in a normal typical market, you may not be able to trade instruments like gold or US30, stuff like that. Now, once you have the leverage, now you can be able to trade such instruments. So the leverage is represented in a ratio. So an example can be, say, 1 to 100. So say your account is $1,000 and you use a leverage of 10 to 1, right? So that means the broker is going to get your trading capital, that being $1,000, right, times your leverage, which is 10, and that means you can be able to trade with an amount of about $10,000. Now, something about the leverage is the bigger the leverage, the bigger the risk exposure. So an example can be, say, if you are trading like on $100 and you use a leverage of, say, 1 to 500. Okay, so that means you're going to get the $100 times 500 as your leverage, and that means you have buying power of up to 50,000. Now that means you're going to be tempted to open up positions, bigger positions, but in actual sense you are trading with only $100. So it's better to use just a moderate leverage. It may not be too big or too small. Now the next keyword is bid price. So this is the highest amount a buyer is willing to pay for a currency. We can also call it the buying price. Remember, we are buying and selling, so there is always a buying price and a selling price. And the ask price can also be called the selling price. Now we also have a spread. Now a spread is just a difference between the bid price and the ask price. Now this is where the broker makes money. And I should be wondering now, how does the broker make money in return? So the broker is going to make money regardless of whether you take a loss or a profit. It's just them taking the difference between the bid price and the ask price, and have made the money. So it's also important to consider this when you are choosing a broker. The broker that you decide to use should have tighter spreads. If the spreads are so big, that means the broker is making way too much money from you, and that's not a good thing. In actual sense, you should find a broker that has tighter spreads that are also favorable to you as the trader. Now, we also have other keywords as going long, which can also be called bullish. So bullish is you buying. We can say you are going long, or you are bullish, or you are buying. They also have going short, which can also be called bearish or selling. That means you are selling. Again, we buy when the price is going to the upside, or you can easily say we buy low and sell high. When I was starting off, I had a problem with mastering this. But at some point I knew, okay, once you buy, sell land or any asset, most often you're going to buy it at a very small amount, and now you're waiting for the price to go up, but then you shall sell. So the last two key terms in trading that you must understand is a lot size. So a lot size is just a unit that you use in trading or measuring a currency. So it's just a unit. Now, the bigger the lot size, the bigger the profit or the loss. So an example can be if someone is using, say, a lot size of 0.01 and someone else is using a lot size of 0.1 or 10. This person could be in a position to make way too much money and still lose a lot more money as compared to this. So the bigger the trading account, the more you could actually be able to use a relatively bigger trading account. Now, there is a very important key rule in trading, and it's related to risk management. You're not supposed to risk more than 2% of your trading account. Now, that means once you are using the lot size, you must understand that, well, this is how much I am risking and this is how much I intend to make. So just go to App Store and search out for Forex calculators and you'll find a list of them. So this can actually help you to determine how much money you must risk or which lot size you can actually use on such a trading account. So a pip is the smallest unit of measurement in trading. So an example is going to be, I made say 20 pips trading Euro USD, or I risked say 15 pips or 10 pips on GBP JPY. So it's just a unit. And now once you have the pips and then the lot size multiplied, you can actually be able to get the money that you either risk or make. When you're trading on a computer, it's even easier. On the MT4 app, it's going to show you how much money you are risking, how much money you intend to make, even showing you the lot size and pips. So it's way too easier. But then on your phone, you could just have to multiply the pips and then the lot size, and then you have the money that you intend to make. Now with that, let's dive straight into the charts. So for you to trade, you need a trading platform. That can be MT4 or MT5. Then we also have what we call TradingView, and this is what we are going to be using. So TradingView is just more of a platform where most traders actually do the analysis, though you can also use it to trade. But the problem with it is it doesn't have access to many brokers as compared to MT4, where you can log in to as many brokers. I'm just going to show you a quick one on the broker. So on your MT4, you are just going to come and click on the section of settings, and then there we go. So we have this section here. So it has your account name or any account that you decide to sign in. So once you want to log in or connect any brokers that you want, you're just going to come here and click on this arrow, and then here we go. So now we have accounts. So currently I have two accounts, one with FX and then another one is a funded account. So right here, I could just come to the plus sign here and then come to log in into an existing account and then search for any brokers that you opened up an account with. Now this is the advantage MT4 has over TradingView. On TradingView, we are kind of limited to the brokers that we have to use. But either you can still do all your analysis on TradingView and execute your trades on MT4. So I'm just going to show you a breakdown right here and how you can trade. Now, as a beginner trader, it's not a good thing to overcomplicate your analysis. No, you need to start small. Now, there is a very, very important rule that you must understand. You must trade with the trend. So like I said initially at the start, that we make money when the price going up, and that's when we are buying, and then sell when the price is going down. So it's your duty as a trader to understand when the price is going up for you to buy, and then when the price is going down for you to sell. So currently we are on GBPUSD and we are going to apply the same rule right here. Now in this example, we can see that the overall trend is to the downside. And now what comes into our mind at this point is looking out for sales. So the biggest rule in here is understanding what the overall price direction is. We can actually scroll through and see. And now in this example here, the price direction was to the upside. Now this is so easy that you're just going to come to your charts and then look through, just scroll through, and you are going to easily establish the trend. Now think about it. So without even having to think a lot or do a lot of analysis, in this example, with the market trend going to the downside, I could easily be convinced that more often the price is going to come continuously down. Now I haven't drawn any other levels or considered any other ideas, but that's what is in my mind. Why? Because the overall bias is to the downside. Now once you understand that, the next thing is drawing any levels. You need to understand, could there be any levels that might have been respected or that might have been tested and respected multiple times, so you can watch out for those. So I'm just going to go ahead and this is called zooming in, zoom out. So I'm going to zoom in, and here we go. So now this is how we look like. So I can just draw random levels. I'm just going to grab my tool here, and then I'll have this. Okay, so I've marked out this level because I can see that the price came. So the price came, hit this level, and then it bounced off, right? That's how easy it is. And then I can also draw any other levels. Now, mind you, I'm just drawing these levels randomly. I'm not considering this and this and this. But then in a minute, we are going to extend those and then see. So I can also draw, say, one around here, perhaps. And basically, so those are, maybe I can also draw, say, one more. So I have about 3 levels now, and you can play around with these and then see. Good. So in this example, I'm considering this. You can see the price hit here and then bounced off. So under technical analysis, this indicates that, well, once the price hits this level, perhaps it could do the same thing as it did previously. But that's again under technical analysis. So we had this level here. You can actually adjust it to have better levels. So now here we go. So now it's a very better one. We can see that the price hit over here and then it bounced off, and then we can also see that the price hit here once. So it hit here once and then twice, and we can see the price hits, goes over just that way. And that's what basically we can look out for. So in this example, I'm just going to look out for buys. Now I can just go to H1. H1 is just a time frame. I discussed that again in the previous video. I'm going to put the link somewhere up here. And that's how it is. So right here, I'm just going to take sales for the purpose of this video, so I can show you guys how you can open up trades and all that. But more often, GBPUSD is going to come down more. I've not done a lot of analysis and having to check out for any levels. Though before you take a trade in actual sense, you might have to do more analysis. You can actually check out more of my trading strategies on the previous videos that I did. So I'm just going to come to my MT4 and here we go. So I'm just going to look out for GBPUSD. So this is GBPUSD. The spread is 5. So come over here and click on the chart. So we have the setup. So just come over to the section of trade here, click on trade, and now this middle figure here is what we call the lot size. We had discussed that it's important to understand the lot size that you are using so you know how much money you are risking in return. So I'm going to use 1 for this account because my account is about $16,000. So I'm just going to click that and then click sell. And here we go. Now this is how my trade runs. I'm actually going to add in one more, and it's a real account. So a real account has your account number and the word real, but for demo account it has the demo flag, green flag somewhere. And by the way, if you are still watching, click the link just down, fill in your email address, and I'll send you something special. So now I have the positions opened up, and I'm just going to set a stop loss. So in this example, say I opened up my trade right here, so I could set my stop loss, say around 41.70. So I'm just going to come over here, click on the pen, stop loss, and I'll say 41.70. So a stop loss is just a level that is going to automatically close off your trade once it goes against you, because at some point you may not be watching the market every time. So this level is going to close off your trade automatically just in case it goes against you. Then I can also set my take profit. So in this case, my take profit is going to be around 123.74 or 123.074, and then there we go. So now I have both levels. Okay, these levels look so big. In actual sense, it shouldn't be that big once you are setting these levels. So your take profit should be bigger than your stop loss in any case, because your take profit is the money that you intend to make, and then your stop loss is the money that you intend to risk. You can actually make as much practice using any trading strategy as many times as possible. Actually, the more practice, the more better you are going to become on these charts.